Credit cards are marketed as tools of convenience, tools of empowerment, tools of modern life. Swipe now, pay later, earn points, get rewards, build credit, enjoy flexibility. To most people, credit cards feel harmless, even smart. They promise free flights, cashback percentages, exclusive perks, and access to experiences. They're portrayed as a way to beat the system, to get something for nothing, to be rewarded simply for spending money you were going to spend anyway. But credit card companies are not giving you rewards out of generosity or goodwill. They are buying your behavior. And once you understand how the system actually works, once you see past the marketing and into the mechanics, it becomes absolutely clear why credit cards are one of the most profitable financial products ever created. Before we go deeper, this channel exists to break down how systems actually work, not how they're advertised, not how they appear on the surface, not how companies want you to think about them. We examine how power actually operates in modern economies. Because once you understand the system, you stop being surprised by the outcomes. Now, let's talk about credit cards. At the surface level, credit cards look remarkably simple. You borrow money for purchases. You pay it back within a billing cycle. And if you do it responsibly, if you never carry a balance, if you pay on time every month, you earn rewards for your spending. That's the story they tell. That's how it's marketed. That's what feels true when you're looking at cashback percentages and travel points. But the real system, the actual business model, operates several layers deeper than that surface narrative. Credit card companies make money in three main ways, and understanding these revenue streams reveals why the entire system is designed the way it is. First, interest. Second, fees. Third, transaction capture. Rewards are not the business model. They're not the profit source. They are bait. Carefully calibrated bait designed to get you into the system and keep you there. Let's start with interest, because this is where the largest profits hide. When you carry a balance on a credit card, when you don't pay off the full amount by the due date, you're often paying interest rates that range from 18% to over 30% annually. That's not an accident. That's not an oversight. That's not a temporary market condition. Credit cards are unsecured debt, meaning there's no collateral backing the loan. No house, no car, nothing the lender can seize if you default. To compensate for that risk, to make the mathematics work, lenders charge extreme rates. But here's the key detail that most people miss, the structural insight that explains everything. The system is designed assuming that many people will carry balances. If everyone paid their card off in full every single month, if no one ever paid interest, if every cardholder behaved perfectly, the business model would collapse almost immediately. Rewards would disappear, credit limits would shrink, benefits would evaporate. The entire system depends on imperfect behavior, on human weakness, on life happening. Credit card companies don't need everyone to struggle. They don't need universal failure. They just need enough people to revolve debt, to carry balances from month to month, to pay the minimum while life gets in the way of paying the full amount. And statistically, they know exactly how many people will do exactly that. Now let's talk about fees, because they're not just a secondary revenue stream. They're behavioral engineering. Late fees, over-limit fees, foreign transaction fees, cash advance fees, balance transfer fees, penalty APRs that spike when you miss payments. Each fee is relatively small in isolation. $30 here, $40 there. Individually, they feel manageable, even if annoying. But together, across millions of cardholders, across billions of transactions, they generate billions of dollars in pure profit. More importantly, fees are behavioral correction tools. They're not just revenue. They're punishment mechanisms that train you to comply with the system's preferred patterns. Miss a payment, and the cost spikes instantly. Go over your limit, and fees appear. Step outside the designated boundaries, and the system reminds you immediately that deviation is expensive. The system trains you. It shapes your behavior. It teaches you to stay within its rules. And most people don't even realize they're being trained. Then there's the most invisible, most overlooked source of profit: interchange fees. Every single time you swipe a credit card, every transaction you make, the merchant pays a fee, usually between 1.5% and 3% of the transaction amount. That fee is split between banks, payment networks like Visa and MasterCard, and processors. The merchant absorbs the cost, which often gets passed on to all consumers through higher prices. This means credit card companies earn money every single time you spend, regardless of whether you carry a balance, regardless of whether you pay interest, regardless of whether you're a responsible user. More spending equals more revenue. Always. Automatically. Now connect this to rewards. Suddenly, the entire structure makes perfect sense. Cashback, points, miles, travel perks, shopping portals, bonus categories. Rewards are not gifts. They're not bonuses for being a good customer. They're precisely calibrated incentives designed to encourage more frequent spending, not smarter spending. Studies consistently show that people spend significantly more when using credit cards than when using cash. Not because they're irresponsible, not because they're bad at math, but because pain is delayed. You don't feel the cost immediately. You feel it weeks later when the bill arrives. And delayed pain fundamentally changes human behavior. Rewards amplify that effect exponentially. A 2% cashback offer sounds like a gain. It feels like you're winning. But if it nudges you to spend even 10% more than you would have otherwise, the system wins massively. And statistically, behaviorally, psychologically, it usually does. If you'd like to see more breakdown of the system, like and subscribe if you want to understand how other systems really work beneath their surface narratives. This channel focuses entirely on revealing how institutions actually make their money, not the stories they tell, the mechanics they hide. Now, let's continue with credit limits. Credit card companies don't increase your credit limits as a reward for responsibility. They don't raise your available credit because you've proven trustworthy. They increase limits to increase exposure, to increase potential revenue. A higher limit means higher potential spending, which means higher interchange fees on every transaction. It also means higher potential interest payments if you eventually carry a balance. Credit limits are not trust signals. They're not badges of honor. They're revenue levers. The same logic applies to introductory offers. 0% APR for 12 months. Massive sign-up bonuses. Triple points on certain categories. These are acquisition tools, customer capture mechanisms. The goal is to bring you into the system, establish spending habits, integrate the card into your daily life, and then let time do the rest. Credit card companies think in years, not months. They play long games. They know that life happens. Emergencies arise. Income fluctuates. Medical bills appear. Cars break down. Jobs get lost. And eventually, statistically, many people will carry a balance. The system doesn't rush. It waits patiently because time is on its side. Another layer that most people never consider, never even think about, is data. Credit card companies don't just process payments. They collect massive amounts of behavioral data about you. Where you shop, what you buy, how often, how much, what time of day, what days of week, when your spending spikes, when it drops, what categories dominate your purchases. This data feeds sophisticated pricing models, targeted marketing strategies, risk assessment algorithms, and credit decision systems. You are not just a customer to these companies. You are a dataset, a behavioral profile, a collection of patterns that can be analyzed, predicted, and monetized. And the more you use the card, the clearer and more valuable your financial profile becomes. This is why rewards are personalized, why offers are targeted specifically to you, why credit limits are adjusted dynamically based on your behavior patterns. The system is constantly learning from you, constantly refining its understanding of who you are and how you behave. Now here's the uncomfortable truth that makes this system so effective, so durable, so difficult to resist. Credit cards are not designed for people who want to optimize their finances perfectly. They're not built for robots or perfectly rational economic actors. They're designed for people who are human, people who get tired, people who face unexpected expenses, people who delay difficult decisions, people who justify purchases emotionally, people who respond to incentives and rewards, people who make mistakes. The system doesn't exploit stupidity or ignorance. It exploits fundamental human psychology. That's why even financially literate people, even people who understand the mathematics, can fall into credit card debt. Intelligence and knowledge don't override human behavior under stress, fatigue, or emotional pressure. Institutions understand this deeply. They study it. They model it. They design around it. Individuals often don't understand it about themselves until it's too late. And just like banks create money and insurance companies price risk, credit card companies monetize behavior over time. They don't need to trap everyone. They don't need universal failure. They just need enough people, consistently, behaving in predictable human ways. The mathematics work perfectly as long as enough people carry balances, pay fees, and spend more because of rewards. And they do, consistently, predictably, year after year. So what's the actual lesson here? What should you take away from understanding this system? Credit cards are not evil. They're not scams. They're not inherently bad products. But they are not neutral. They are not simple tools. They are not what they appear to be on the surface. They are sophisticated financial instruments designed specifically to extract value from predictable human behavior patterns. Used carefully, strategically, with full awareness of how they work, they can be useful tools. Used passively, automatically, without understanding the mechanics, they become financial drains that transfer wealth upward quietly and consistently. The problem is not rewards themselves. The problem is not convenience. The problem is not building credit. The problem is forgetting who designed these systems and why. The problem is not seeing the invisible mechanisms working beneath the surface. Most people see points and perks and convenience. They see the surface story. Institutions see probability curves, revenue streams, behavioral models, and long-term profit patterns. That fundamental difference in perspective explains the difference in outcomes. And this is the pattern you should start noticing everywhere now, in every system, every institution, every major industry. McDonald's doesn't really sell burgers. It owns land and collects rent. Banks don't store money. They create it through lending. Insurance doesn't protect you. It prices risk and redistributes it profitably. Credit cards don't reward you. They monetize your behavior over time. Once you see the system underneath the surface story, once you understand the actual mechanisms, you can't unsee it. The world starts looking fundamentally different. Every institution, every major company, every financial product starts revealing its true structure. And that changes everything about how you make decisions, how you evaluate offers, how you think about money and power. The credit card in your wallet is not what you think it is. It's not primarily a payment method. It's not mainly a rewards program. It's not just a convenient tool. It's a carefully designed behavioral modification system that generates profit from human psychology. The companies that issue these cards have spent decades and billions of dollars understanding exactly how people think, how they behave, what triggers spending, what encourages debt, and how to maximize revenue from these patterns. You cannot beat this system by accident. You cannot ignore it and hope for the best. You can only succeed by understanding it fully and using that knowledge to make conscious, strategic decisions. The system is not hidden. It's just invisible to people who never look past the marketing. But now you know. Now you see it. And once you see it, everything changes. If you want to keep seeing what's usually hidden, subscribe.